at the Money Show in Toronto, and we're live on location with Mike Larson, who is the editor and publisher of the Safe Money Report and a senior analyst at Weiss Ratings. Thank you so much for joining us on SmallCapPower.
Thank you. Glad to be here.
So what's your current mindset like when it comes to the current economic landscape and the investment opportunities out there?
Sure. Well, we've had this 9+ year bull market, especially more recently the US has been outperforming several other markets around the world. And I think we're getting to the point where we might be sort of at the edge of something different, a turning point for the markets. We're seeing more divergence in the US market, some of the more defensive sectors, utilities, real estate investment trusts, names like that are starting to outperform, whereas some of the prior leaders are starting to lag. And I think that's a symptom of the market just getting tired. You know, we've reached this point where valuations are extremely stretched. People have been banking on strong economic growth persisting, but behind the scenes you're seeing some trouble in the credit markets, you're seeing asset valuations get stretched, and that's why I think for an investor now is the time to focus on safe money stocks and safe money sectors. Start rotating out of what has been working and into what hasn't yet, but I think will in the future.
What kind of companies, businesses are stable growth picks in your eyes?
Sure, again, when I look at the things that we're recommending to our investors, you know, a year or two ago, it was financials, it was technology, industrials, growthier type names. But now, what I'm looking at is things like utilities, things like consumer staples, high yields, high Weiss ratings, sort of recession resistance. I mean, you have things like the yield curve flattening, the credit market's starting to get a little more nervous, and that's what you see at the end of an economic expansion. So I want to be telling people, look, you've made a lot of money in some of these higher growth, higher risk sectors, and now it's time to rotate into safer things.
Mike, talk to us about Weiss Ratings and your research process there.
Sure, Weiss Ratings as a firm has been around for decades. We actually rate more than 40,000 stocks, ETFs, mutual fund classes, and so on, with a quantitative system. It's designed, the model has been time tested. It is designed to give you a simple idea: is your stock an A, a B, a C, and so on. There's plus and minus categories within that, and it gives you a good sort of reality check. You may, hear on CNBC or BNN that this company's great, its business is wonderful, but how do the fundamentals really look, and how's the technical momentum behind those names? Weiss Ratings gives you that sort of independent, objective, formula-driven, model-driven analysis of these companies, and it's a great resource for investors.
Wonderful. And when you're writing your Safe Money report in the last few months, what is the dominant theme that's dominating your newsletter?
Sure, again, it's been, raising more cash ever since we had sort of the blow-off high in January, the big shakeout that we had in February. Since then, the market's had a much different tone. This is not the same bull market that we had from March 2009 to, I would say, January 2018. It's much more divergent now. So in that kind of environment, you want to keep more cash on hand, you want to be rotating out of riskier assets and into safer sectors, and you want to start hedging a little bit. I think, inverse ETFs, put options, things like that, haven't had a place in a portfolio during this long bull market because you've lost money with them. But now is the time to start looking at some of those techniques and some of those investments that haven't worked for years and that might work going forward in 2018 and 2019 especially.
Thank you so much for your insights, Mike. Thank you.
Thank you.